All right. Good morning, everyone. Today, I just want to talk about, is there a flight to safety going on in the markets? Now, why is this important? Well, because when flight to safeties end, markets tend to go down. What is a flight to safety? Quite simply, it's when people sell stocks that they perceive to be risky and buy stocks that they perceive to be safe. Notice I am saying the word perceive. Now, you might say, well, why, if you think the market's going to go lower, well, then why wouldn't you just go to cash? Well, in the institutional trading world, you have these mandates that are put on you by your clients, the people that invest in your fund. Actually, you can see it very clearly in the mutual fund world. So, some mutual funds, as far as I know, most mutual funds have a mandate where they can't be more than X percent cash, like maybe more than 5% cash or 3% cash. So a money manager may think the market's going lower. They may be completely right. They may want to just sell everything and just sit in a cash position, but they can't. They have to have it exposed in the market. It's got to be invested somewhere. That's what their clients want. That's their client's mandate. So they sell the stuff that is perceived to be risky and they buy the things that they don't think are going to go down as much. Now, what are probably the two stocks that are considered the safest right now? Apple and Microsoft. All right, Apple and Microsoft together are 7% of the S&P 500. There's 500 stocks and these two are 7% of it. So I think what could be going on here is that money is coming out of a lot of the more stocks than they're going into, but because of the weightings of the benchmark, it kind of skews performance. Or I'm sorry, it skews what's going on, or it masks what's going on behind the scenes. So real quick, just want to show you the S&P 500. We got to watch this 416 level on the upside, 405 on the downside. We could see here 405 was support. People bought here, but then when the price went lower, a lot of these people tell themselves that they're going to get out at break even if they can. And if there's enough of these orders, what was support becomes resistance. Now we have the opposite. People sell here when the market goes higher. A lot of the people who sold tell themselves, I made a mistake. I want to buy my shares back. If you have enough remorseful sellers placing buy orders, the level that was resistance can turn into support. So that's what's happened here. Now here we had resistance around 416, 416, 416. So how is it that a level that was resistance can remain resistance for a long time? Well, it's another example of market psychology or buyer's remorse. Remember, we have to look at all these charts through the prism of what does it tell us about psychology and supply and demand. These patterns are not mystical astrological things. If interpreted or viewed correctly and if understood, they are graphical illustrations of psychology and supply and demand. Now think about this. There were people who bought up here who regretted doing so when the price went lower, and they tell themselves, man, I made a mistake. If I can get out at break even one day, I'm going to. So we have remorseful buyers placing sell orders at the level that was resistance. So levels that were resistance can stay intact for a while. And it's the same thing with levels that are support. This is pretty much the exact opposite. You have people that are short here and the price goes higher, they regret shorting, they tell themselves if I can get back at break even, if I can buy my shares back at the same price I shorted them, I'm going to. So if you have enough of these people placing buy orders, the level will continue to be support for a while. This is what we call market memory. Sometimes an important price level can retain its importance for months. I mean, I've even seen for years. Now, my suspicion, which I think I can pretty much prove, is that a lot of money is coming out of different parts of the market and it's just kind of piling into Apple and Microsoft and some of the other big tech stocks. This is the biggest sector in the market, and as you can see, look where we're pinned at, right at 151. I mean, yesterday we closed our pre-market were 150.38. This line is 151. Look at how precise this resistance is. So resistance here, resistance here, resistance here. A lot of people take this for granted, but if you think about it, there's not an academic in the world that can explain how this happens. If you're a trader and you understand psychology of the markets, you can. But how is it that the technology sector has the exact same valuation today that it did last August, considering how so many things have changed since then? And The answer is because charts are driven by human psychology, or markets are driven for the most part by human psychology. Forget what they're saying on CNBC or Fox Business News or whatever it is you watch. 98% of the time, they are wrong about why the market is moving. Markets move, if there's no specific news, a market moves because of a technical situation. For example, we get to a resistance level. Why do we sell off? Well, because there's investors who want to sell, and when they start to look around and see, gee, the price isn't going higher anymore, that must mean there are sellers coming into the market. So I better reduce my price because if someone has a lower price than I do, that's who the buyers are going to go to. So we get this snowball effect and we get the sell off. The exact opposite happens when we get to support. There are people that want to buy and they notice that the price has stopped going down. So they start to get worried that there's other buyers entering the market. And if someone else is willing to pay a higher price, that's who the sellers are going to go to. So we have buyers outbidding each other, and that drives the price higher. So resistance remains resistance because of psychology. Resistance can turn into support because of psychology. Things get to resistance and sell off because of psychology. Things get to support and imbalance because of psychology. So it's all about the psychology. Now, this here is kind of an interesting thing, right? Like I said, Apple and Microsoft are way overweighted. Or, well, I mean, they're not way overweighted, but they're such bigger market caps than these other companies that they have a much more influential impact on the benchmark or on the indice or the benchmark than all the other stocks do, right? So theoretically, money could be coming out of 400 stocks, 98 of them could be flat, and there could be two that are going higher, and that could potentially make the market look like it's going higher. It masks the underlying fundamentals, the way our market fundamentals. Now, here is our Nasdaq 100, and this is a ETF that is equally weighted. Okay, every stock in this ETF has the same weight. They're just balanced by, I guess, 1% in each because it's 100 stocks. But in this index, certain stocks don't dominate it. Now, let's just go back to late 2021. The broad market, the S&P 500 or the Qs or whatever you're looking at, peaked in late November. I mean, sorry, take that back. Peaked in late uh, December and early January. Now, notice this. This peaked in November, fully a month before those other benchmarks or indices did. This showed us that the market uh, underlying or the market conditions were really starting to deteriorate. At the same time, the Qs or the S&P 500 continued to go higher. That's because money was coming out of all the small names and going into the big names that were perceived as being safe. It's a flight to safety. So the one that's equalated peaked in November. So this was an early sign that we were getting close to the top. And then in late December and early January, the other things peaked because the flight to safety came to an end. Once all the money that was going to go into Apple and Microsoft was spent, well, the only place they could go is down. So the way some of these benchmarks are constructed can mask deteriorating market conditions. And that's exactly what happened back here in November and December. And I'll show you the regular Qs chart in a second. But what I want to point out is this. Now look at this, right? So we're going down here again. So this means most of the stocks in this NASDAQ 100 are going lower. Now, remember, peak in November, equal weighted, peaked in late December. This is the regular Qs. So money was coming out of most of those stocks and it was going into Apple and Microsoft. And because that this is a market capitalization weighted benchmark, those two stocks, which are probably about 20 or 30% of this, were going higher. So that pulled the whole benchmark higher, even though most of the stocks were going lower. So now we can see here kind of the same thing is going on. We have the Qs are in an uptrend, but the Qs with the equal weight is in a downtrend. So most of the stocks in the NASDAQ 100 are going lower. But because of the way the benchmark is constructed, the NASDAQ 100 keeps moving higher. In other words, say theoretically, 80 of the stocks are being sold, and all that money is going into Apple and Microsoft, which is pushing them higher, and that pulls the benchmark higher. So the way these benchmarks or these indices are constructed can hide or mask underlying deteriorating conditions. And there's a good chance that that's what's going on now. So this could be a flight to safety, and flight to safeties tend to be bearish because when the money runs out of wherever it's going to be safe, then the only place it can go down. And then not only do you have the vast majority of the smaller stocks in the benchmark going lower, now you have the big ones moving lower, and that sets us up for a broader move down in the markets. All right, so just remember, everybody, flight to safety. People sell stocks that they are perceived to be not safe and going to stocks that are perceived to be safer. When we have a benchmark where we have a really high market weighting, for example, the Qs is 20% of Apple and Microsoft, and the other 98 stocks account for the other 80%. The vast majority of those stocks could be going lower, but if the money is going into the 20%, that could be dragging the thing higher. And once that runs out, then the only place the market can go is lower. So the Qs peaked at the very top of the bull market in late December of 21. The equal weighted benchmark, where every stock has the same weight, peaked a month earlier. So that was a sign that the top was coming. So right now we have the Qs going up and the Qs with the equal weight are going down. This could be a sign of flight to safety. So make sure you check back, and I will talk to you soon.